All right. Take care, Mitesh. We'll keep coming back to you, and God bless you. Well, let's get in Prakash Diwan to talk about a few stocks. Well, Prakash, I wanted to ask you about a couple of stocks in the broader markets that are still virtually at the high point of the day. SBI Cards. Now, that's the only direct play you have on the credit card space here in India. And that's given you quite a large correction from the recent peak. Though the data points that came out for the last month suggested that people are swiping left, right, and center. And, this one as well is doing pretty well. Your take on the stock, it's up close to 4.5%.
Good afternoon, Nigel. So my sense is, very clearly, these kind of moves in players that have a secular stressful journey, it's best to be seen as an opportunity to book out or exit. Remember, some of the key institutional investors who have been in this business even before the IPO have also chosen to exit some time back. And that tells you that globally, given the way technology is kind of changing and the way the UPI regime in India is so successfully all pervasive, the card business is going to find it difficult. In fact, I just saw something like a small bank trying to improvise on that by helping you customize your card, because you will have to keep on reinventing yourself. You will have to make yourself relevant. Otherwise, this is a business that is only going to have costs attached to it and with not commensurate gains out of it. So I think any move in SBI Card from this correction that you see for people who have still been caught into it could look at it as an exit. I'm not a big believer in this side of the business at all.
Okay, for now, the stocks, the top F&O gainer, like Nigel pointed out, even despite the market seeing profit taken from higher levels. The market, by the way, is making another attempt at a rally, so don't lose sight of that. The Bank Nifty in particular has been strong. But, let's talk about the biggest loser now. That's RBL Bank. Now, this is one stock where the market is still nervous, given the developments. It's just been one-way decline for the stock. Abhishek is going to tell us how the numbers looked in terms of the data that the bank reported. Abhishek?
Well, Anuj, as you mentioned, the bank has come out with its operational update, wherein it continues to lose market share, and there is a lackluster in terms of the business momentum that they have seen in Q1 FY23. So deposits growth on a YOY basis is at 7-quarter low of just 6.4% YOY and about just 0.27% on a sequential basis. Advances, they had a base effect given the fact that in Q1 FY22, it declined by 3.5% YOY. So despite that base effect, it's grown only by 6.5% YOY and about 0.24% on a sequential basis. They continue to lose market share in terms of the loan momentum. The market share is now down to 0.51% when compared to 0.54% in the same quarter last year and about 0.52% in the previous quarter. The good part about their operational performance is that the CASA, or the low-cost deposit ratio, is at all-time high of 36%. Back to you.
Thanks, Abhishek, for that. Prakash, what do you do with a stock like this? Because, the price action has been so eerily similar to Yes Bank. There are a lot of concerns now. 80 on the stock.
I know, Anuj, it's quite sad, to see a good flourishing bank lose its way in terms of market perception or market appetite. While the core business could probably still have some sort of a correction and repair underway, my sense is, given the kind of choice that you have in smaller banks on the private sector side as well, I really believe it will be a very high-risk trade to buy into RBL Bank, because, yes, there could be some corrective moves on the way up. You could see it go back to triple digits in a hurry, but then, whether that's going to sustain or not, would depend a lot on the operational metrics, the flow of improvement thereof. And look at how Yes Bank itself is kind of reshaping it after a painful journey. In fact, those numbers seem fairly flattering, to be honest. I mean, I didn't expect the improvement to happen so soon, but there is some semblance of correction there or improvement there. I'm not saying it's a recommendation to look at Yes Bank to buy, but given the fact that it has withstood all the storm that it saw on its balance sheet, that's kind of finally making some improvement. So it takes a long time for that to happen, and RBL Bank could go through a similar trajectory, if not identical. And that's why it's in avoid at this point in time. In fact, the banking space is offering much more options. Let's say a federal bank, perfect size, has the ability to grow, continuity of leadership. All sides of the portfolio are growing. Gold loans, SMEs, all of those have been, fairly better than some of the other banks. So I think if you had to dip into this space, this segment, you would have that. And then there are turnarounds. There are a Karur Vysya Bank kind of turnaround, but they're too small. So, I mean, I wouldn't compare the two, but I would believe a Federal Bank offers far better salience at this point in time than an RBL.
Okay, by the way, just don't lose sight of the market. It's been very volatile. The mid-cap index is about to turn in the red once again. Let's pull out the chart of dollar index if we can. I mean, intraday would be the best, but even if we can't, if we look at the dollar index itself, this is a bit of a breakout on the dollar index. And actually, I'll tell you why, especially days like today, Nigel, when you don't have the previous night's US market action. So sometimes, the domestic traders do get a bit cocky about things. This is still a concern. If the dollar index has to cross 106, 107, I think the dollar euro, for example, is approaching parity. I think that will be the other big event to talk about. This has direct impact on fund flows. I know there's one part of the market which believes that falling currency is actually good, but from the market point of view, that's always an indication of the way the money is moving out. So I think that's an important cue. Yeah. And on top of that, Brent crude prices are also sticky, and they've not gone up a lot, but they've been sticky at around that $113, $114. So combination of that is something which is not really good news for our macro. And that's why you're seeing this move.
And I think the last leg of this rally, this recent 300-point rally started when the dollar index dipped to sub 104.
Yes.
So that clearly is weighing on sentiment as well. When the dollar index goes to around this 106 odd, so that's clearly a worrying sign that we are seeing. And as Anuj pointed out, the mid-cap index, that's suddenly seeing a lot of stocks just fall off the cliff. If you pull up SRF, pull up the intraday chart out there, the stock was higher, just an hour or so ago. Now that one, in fact, is lower in trade. And remember that this stock has corrected substantially from the recent peak. Ramco Cements as well, another one that's taken a bit of a knock. And the mid-cap index now is in the red as we speak. So things looking a little bit eerie as we speak. Well, we'll slip into a short break. We come back. We'll get a lineup of our guests to take the discussion forward on markets. The breadth of the market that was looking very, very good. Suddenly, those crisscross lines are getting very, very close to each other. So the advanced decline ratio at one point of time, we are closer on 2,700 stocks that were advancing. Now those stocks, in fact, have got closer to each other. And from the broader markets, quite a few stocks are selling off. India Bulls Housing Finance as well was in the green. Now that one's moved into the red. So pull up the intraday chart. You'll, check that one out. But a more popular name or one stock that's made a lot of money in the last few years has been SRF. Stock has corrected now 30% from the recent peak. Prakash, that's down 5% now, on the verge of going towards 2,000 rupees. The high was around 2,700 rupees. What's your view on this stock? Business looks solid. Valuations maybe got stretched. Your take.
Oh, absolutely, Nigel. You said it. From those 2,700 plus highs that we saw, the reason is simple, and we spoke about this. Anuj and I remember one of these sessions we had where we were talking about the reset that's evident in these chemical names, the darlings of the chemical sector, and all that PE contraction that we saw, and the market needs an excuse, whether it's a Deepak Nitrite, whether it's a GNFC, or whether it's an SRF. So from that perspective, I think it's kind of seeing a little bit of that sell-off. And remember, thanks to the margining system, it's been a slow grind. It's not been like a very precipitous fall for most of these names. Otherwise, it would have been fairly sharp. But my guess is that this correction would probably be deeper from a P contraction perspective. While it's good news for value investors because the EPS starts looking up even more promisingly. There are supply chain issues that SRF is also definitely facing. The volatility in its input prices itself, raw material prices itself is such a limiting factor. But I would believe that there's a basket of chemical names which will start holding forth. Probably another couple of months' time when there's some visibility and then the money flow starts chasing these names. But at this point in time, notwithstanding the China plus one and the buoyancy in the global markets and stuff, there's a lot of rationalization that's still underway. You could go see a more of a time correction in this, if not necessarily on the price. So stay put. It's a great business to own at some point. But you probably get your time to buy at about closer to, sub 2,000 levels for sure. But give it time is what I would.
By the way, just want to point out that IT stocks are now hitting lows of the day, which also tells you that it's not just a straight play. Currency weak and IT stocks will rally. That doesn't happen anymore. The Nifty IT, and that's actually been the weakest of the indices, and every rally, every small rally is being sold into, starting with the biggest of the names, TCS. TCS, of course, comes out with numbers on Friday. But just look at the price action in a lot of these names. Wipro, for example. Wipro in the last year's IT rally was the strongest large cap IT stock. And for the last 2 quarters, something has just changed. It's about to become half of its peak. That's the brutal fall that we have seen. Prakash, any word on names like Wipro before we let you go?
No, so I would wait for again, this is a reset of the PE. We will see those median PEs come back, which are still some time away, some levels away. Very clearly, businesses like Wipro, which have had a journey of inorganic growth, will have to digest and start showing that. And with this environment where the margins are under pressure, any new acquisition that you make only makes it more difficult or even more, elongated in terms of the timelines. So I think the recovery will probably happen in the likes of Tech Mahindra and all, which are already robust enough in terms of this thing. They don't have any baggage to carry. But the margin reset is still awaited in most of the larger players. It's not easy. And this recession thing that we are worried about in the US will, of course, have an impact in terms of, the bargaining power that most of these companies have. So new contracts will probably be negotiated at lower margin profiles. And that's exactly one of the reasons which the currency could probably make up for some time, but not forever. And that's why you'd probably see a little bit of sell-off or some sort of a move away from IT stocks to continue for another quarter or so. And then things could look different. So wait for it. But Wipro could also be valuable, as you said, at the, probably mathematically half of what it used to be at some peak levels in the recent past.
Okay, Prakash, thanks a lot for joining us. Just one-way decline, really.